So equity investments comes in your part two, that is the afternoon or whatever you call the PM exam. Now in this, you have the remaining five topics, equity being very easy, very interesting, very few calculations here, not too much of calculation as what we would expect. But the good thing is that equity has a sizable weightage. So in your exam, you have around 11 to 14 percentage of weightage, which is going to give you 20-25 questions. Now you should see this as an opportunity, because if you score your well, your part two will be taken care of very well, right? Again, as I said, there are few questions related to calculation. Otherwise, it's pretty much smooth. And most of the CFA candidates who are doing who are giving CFA level 1 exam, they are very interested in finance, I presume, right? So then this should be a topic which should be your favorite and easy to do. Nothing rocket science here. Okay. So let's start with that. The 8 readings in the flow, your calculations are mostly concentrated in the first and the last reading. All right. Correct. Let's start. Which of the following from the first reading, where we are going to discuss about market organization and structure, this is a very lengthy reading. Which of the following is not a function of financial system? Financial system is financial markets, financial instruments, and financial participants. So which one is not the function? To regulate arbitrages, to help the economy achieve allocation efficiency, to facilitate borrowing. Which one is not? Everyone, please try and let me know. Yes, check, 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 check. To regulate. Regulation is the job of financial markets or financial system? No, it's the job of the regulators like SEC. So it's the job of the regulators, correct? For that, you have a separate organization, correct? A hedge fund holds excess cash in a 90-day commercial paper and negotiable certificate of deposit. Commercial paper for corporate, certificate of deposit for bank for less than 1 year. Can you tell me any instrument which is invested for less than 1 year? What is it called as? Everyone? Money market. Money market. Everyone with me? Check, check, check. Very good. See, these are very easy questions. So I'm moving forward. Okay. Wherever there is an issue, let me know. An oil and gas exploration and production company announces that it is offering 30 million shares to the public. The transaction is most likely a sale in the so easy. Primary market, IPO. IPO is a part of, guys. IPO. Whenever you issue the shares, IPO, it's a part of a primary market. Everyone with me? Okay. Which of the following statement about ETF, exchange traded fund, which you can buy from an exchange? It's a fund which you can buy from an exchange which trades throughout the day. ETFs are not backed by any assets. No, they are backed. Correct? Everyone? The investment companies that create ETFs are financial intermediaries. Everyone? They are asking which one is correct. The transaction cost of trading shares of ETFs are substantially greater than combined cost of trading underlying asset. Guys, overall the cost is lower, right, of trading ETF. Everyone in the class, right? So ETFs are, what is the correct answer? ABC are not backed by asset. I think this is just by mistake. Are not backed by assets. Everyone, they are backed by asset. The investment companies that create ETF are financial intermediaries, right? Yes, financial intermediaries like mutual funds and all, they are the only ones who create the ETF, correct? So this is the right statement. An online brokerage firm has set minimum margin requirement of 55%. Very interesting. Minimum margin requirement. Guys, when there is a minimum margin requirement, it gives you maximum leverage ratio. What is maximum leverage ratio? It is nothing but 1 over minimum margin requirement. What is the minimum margin that you need? That is 55%. So if I do 1 divided by 55%, that's the maximum leverage, which is 1.82. Now the question is, what is the maximum leverage ratio? Remember, maximum leverage is 1 inverse of the minimum required margin. So your answer should be, everyone, B. Clear? Okay, now the next questions are related to calculating the leverage returns. Okay, very, very important. Do expect something like this to come up in exam, because this is a very important question, especially the next one after this, after the sixth one. Okay. A trader has purchased 200 shares of a non-dividend paying stock on a margin at a price of 50. So trader has purchased 200 shares at a price of 50. The leverage ratio is 2.5. That means 2.5 times. 6 months later, she sells the shares at 60. So guys, what is the holding period return here? The stock ending over beginning minus 1, the stock went from 50 to 60, so which is 20%, right? Am I correct? Ignoring interest paid and borrowed amount and the transaction cost, what was the return to the trader during the 6 months? Now, this return is with leverage. Guys, with leverage, what is the leverage ratio here? 2.5 times. So, guys, if I were to find my return on investment, which is leverage return, you need to multiply this 2.5 times. That will give you around 50 percentage. Am I correct? Yes, 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 yes. Now, guys, why did I directly multiply this? You can do so. You can do so. You can multiply that with a leverage ratio only if there is no additional benefit or cost. I'll repeat, you can do direct calculation like this only if there is no brokerage, no interest, no dividend. Only then you can directly, whatever is your holding period return, multiply that with the leverage ratio. Are you with me on this? Understood? However, in the next question, you will see what? You will see there is, okay, margin fine, interest is there, dividend is there, commissions are there, right? In such a case, you can't use this shortcut. The shortcut that I just showed you can only be used when you have the inputs, right? Which inputs? When you don't have additional cost like brokerage or any additional benefit. However, if there is anything like this which you have on question number 7, then our answer won't be the same, everyone. Now, what I'm going to do is that I am going to calculate the next question to show you how exactly this is done. Many students have their own way of doing because they must have studied it somewhere else. I'll show you the process. This is very important. Something like this you should expect in exam. You may, to be ethically correct. There's so much of consciousness that I have to do when there is recording going on. Otherwise, I would be very blunt. Anyways, so we are looking here the rate of return on investment. Now, let me tell you, whenever I look for ROI, rate of return with leverage, I have two components. One is my initial investment, which we call as II, initial investment. And the second part is net sale proceeds. Those who know my notes, from that, I use this II, initial investment, and net sale proceeds. Initial investment is your equity margin and brokerage or commission, if any. Net sale proceed is the sale proceeds minus the borrowed fund and the interest on it. And then you also subtract the brokerage because you pay the brokerage when you exit. However, if there is any dividend, you add that dividend. Are you with me on this? Check, 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 check. Got it? So let's see what is our initial equity. Here you have purchased 500 shares at 32 at a 75% margin. So 500 into 32, your total portfolio is 16,000. Out of that 75% margin, so 12,000 guys is your initial investment, and the remaining 4,000 is your borrowed fund, isn't it? Which is I am going to pay off when I exit. Are you with me? Both the things together. Now, whatever you have borrowed, on that you're going to pay 2% per month. So after a month, 2% on 4,000. So 4,000 into 2%, that is 80. So you are going to pay $80 interest on it. Am I correct? You gonna receive dividend of 0.5 per share, and you sold the shares at 28 per share. So dividend is 0.5 per share. You had 500 shares. So basically your dividend will be 250. Correct? And they said you're going to sell the shares at 28. So 500 into 28, you will make 14,000 when you sell off everything. All remains is the brokerage or commission, whatever they call. He paid $10 on purchase and $10 on sale. Now be careful here. They did not say per share. They said the total amount, 10. All I'm going to do here is 10 will be added as my outflow. And when I sell, this 10 will be subtracted from my inflow. So my net sale proceeds will be 14,000 minus 4,000 minus 80 minus 10 plus 250. Are you getting 10,160? So guys, my ROI is nothing but 10,160 divide by 12,010 minus 1. Let me know what answer you get. Check, check, check. This divided by 12,010 minus 1 into 100. It should give you 15.4 percentage negative. Remember, it's negative, 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 negative because you made a loss. So minus 12.5, 15.4 negative. Everyone understood this? Check, check, check. How's it? Great. Again, something I'm very controlling myself to say it very diplomatically, but very important. Got it? What do I mean by that? All right. Next. A market has the following limit order book standing on its book for a particular stock. The bid and ask size and numbers are given. What is the market? Guys, the market is where the best bid and the best offer is. Best bid is the lowest bid and best offer is the best offer. Best offer is the highest or the lowest, guys. Best bid is the lowest bid. No, 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 no. See, when you bid, you are going to bid, and who will get first? The one who bids at the highest. So the market is at the highest bid and the lowest offer. So this amongst all, this is the highest bid and the lowest offer. This is my market. So 9.95 for bid and offer for 10.02. That is the best bid and the best offer. Am I correct, everyone? All right. Next one, try, everyone. Currently, the market in a stock is 54.62 bid and offer is 54.71. A new sell limit order is placed at 54.62. So I'm putting a sell order at the best bid. Will my order be immediately executed? Yes, correct. It will be immediately executed because I'm offering it even lower than the best offer. Isn't it? So what is this order called as? This is called take the market, make the market, or make a new market. What is it called as? Would you like want to try ABC? Take the market. Yes, it is called take the market. Take the market. Take the market. Understood, everyone? Correct. There is also something called inside the market. If your trade price is within this, it's called inside the market or make a new market. Got it, everyone? Very important. A British company listed this of the London Stock Exchange announced the sale of these many shares to a small group of qualified investors. What is this called as? When you're selling shares not to public but to a small group, that is called as very good private placement, everyone. Amazing. All right. We're still in the first topic, okay? Next, consider an order-driven system that allows hidden orders. The following four sell orders, guys, sell orders, okay? Sell orders. When you see the sell orders, which order will get executed first? The one who is willing to sell at the lowest price. Remember the one who is willing to sell at the lowest price. His order or her order will be executed first. On a particular stock are currently in the system's limit book based on the commonly used order precedence hierarchy. Guys, I'm not sure whether you are aware or not. What is the order precedence hierarchy? One, two, three. First is price, second is display, and third is time. What does it mean? Who gets a priority based on price? So out of the four orders, which one is the lowest? 20.29, because it's a sell order. 20.29 will have the priority. Are you with me? Then, if all orders are of at same price, who will have the priority? The one which are displayed. So who is displayed here, guys? Displayed are the last two, right? Now, they both are displayed. Amongst them, who will get a priority? The one who comes first. First. So this one comes at 953.04. So order number 3 will be executed first. Everyone with me? Order 3. Again, price, display, and time. That's the hierarchy where the computer electronically, automatically matches these orders. All right. Now we go to the topic of indexes, right? Again, in this topic, there are some very important questions, calculations, as well as non-calculations. When creating a security market index, an index provider must first define which market, isn't it? Before you decide on the weights and constituents, you need to define which target market. So that's my number one step. Correct? Target market means emerging markets, global market, domestic market, etc. That is the first step. Now, in the next one, you're going to calculate total return. Total return means it takes dividend also. If they say price return, you should exclude the dividend. Total return includes dividend. But what type of index it is? When they say equal weighted index, in equal weighted index, what we do is that we calculate returns for each stock and then simply do the arithmetic mean. Means all of the returns we divide by 3. That's going to be my total return on the index of equally weighted. Are you with me? So how do I find returns? Ending plus dividend divide by beginning. So I will do 12.75 divide by beginning minus 1. You will get 27.5. Store it. 27.5. Store it. Store 1. Next, 19 plus 1, 20 divide by 20. This is not going to give you anything. This is going to be 0, right? And the last one you will do is 32 divided by 30 minus 1. 32, sorry. Divide by 30 minus 1 into 100. That will give you 6.67. Add the previous one. Divided by 3. Just because it's 0, don't ignore it. Are you getting 11.39? You should get 11.39 percentage. Check. I hope you're getting 11.39. Everyone with me? All right. Got it? Now this is equally weighted. Every index method has a different way of calculation. For example, the next one is market cap weighted. In market cap, what I'm going to do is that I'm going to take the entire market cap. And here also they said total return means you need to include the dividend also. So guys, whether it's the beginning, I have the beginning price, but rather you should take the beginning value. How will you take the value? 2500 into 5000, store 1. 2500 into 5000, store 1. 3500 into 7500. 3500 into 7500, store 2. 1500 into 10,000. 1500 into 10,000, store 3. Add all, you will get 53750,000. Are you getting something like this? So this is going to be 53750,000. I'm ignoring the thousand. Same way you have to do this and this, but with the shares. So you'll do 2700 into, I'm just ignoring the 30 into 5. 2500 into 7.5, store 2. 1600 into 10, store 3. Are you getting 48,250 for the second one? 48,250. And the last one, 100 into 5, store 1. 150 into 7.5, store 2. 100 into 10 plus recall 1 plus recall 2. I get 22 point, basically it's 2.625, correct? 2.625. That's my dividend plus 48.25. So 2.625 plus 48.25 divided by 53.75. Already sense there is something going to be negative, into minus 1 into 100. Are you getting 5.3488 negative? This is your dividend. This is your ending value. This is your beginning value. Same process like holding period return. You should get 5.3488. Check and confirm, everyone. It's going to take time, but you need to speed up. Okay. I mean, in exam, time is not a constraint, but you should not overthink. What is market cap? Market cap means you multiply the value with shares also. Here, remember, they ask me total return index. If they say price return, you need to skip the dividend. If they say so. All right. Understood? Clear this part? Okay. Perfect. Yes. Now let's see some interesting part. Students focus too much on the practical thing, but they miss out on the basic theory things. And they will be surprised when they come out of the CFA exam. They will realize, this is my expectation, that they will realize, oh my God, the exam was so theoretical. It was hardly practical. So the focus is on the logic, not mathematics. Which of the following index weighing method requires an adjustment to the divisor? Remember, there is a method where the divisor needs to be adjusted for split, that is price weighted. Isn't it, everyone? Correct? Fundamental is, fundamental has a tilt. Okay. Market cap doesn't require any adjustment. Which of the following index method is most likely subject to value tilt? Value means, what is value tilt? Basically, you're going to pick up stocks which are undervalued as per you, or which meet your valuation parameters. That is possible only in one type of index, which is fundamental weighted index. They have a value tilt. Someone is answering C. Market cap has a momentum tilt. Market cap has which tilt? Momentum tilt, not value tilt. Let me show you from one of the most famous and one of the world famous notes. Market cap has a momentum tilt, fundamental has a value tilt. Understood? This is by, uh, you know, what should I say? This is by Nobel laureate Kunal Doshi. All right. Come on, it's my class. I can say anything to myself. Okay. Which of the following index weighing method requires the most frequent rebalancing? That is only one. Equal weighted. It requires most frequent rebalancing. Isn't it, everyone? All right. Okay. What is reconstitution? Reconstitution is adding or deleting of securities. Okay. What is the need of it? Because you need to remove the outdated security and add the new securities. Reconstitution reduces portfolio turnover? No, it rather increases the portfolio turnover. Reduces the need of rebalancing. Guys, rebalancing and reconstitution are different. Rebalancing is adjusting the weights. Reconstitution and rebalancing are not the same thing. So, of course, it's a C. The likelihood that the index includes security that are not representative of the target market. True. If there is a security which no more needs to be part of the index, we need to remove it. That additional removal is reconstitution. Understood, everyone? Perfect. Okay. Next is a style index. What is a style index? Style index is something which focuses on a specific theme or a specific style. Everyone. So style index means they focus on value stocks, growth stock. Understood? So an index based on geography, economic sector, or market cap. Which one is style based index? Everyone, ABC, ABC. The one which is based on, see, market cap means value, right? large cap, small cap. So these value represent style. Understood? Market cap represents style. So I'm selecting securities based on cap. When you select securities based on value, that is large cap, small cap, mid cap, or growth, high growth, low growth, or high growth stocks are those which have high growth in PE ratios and all. So those are based on style index. Understood, everyone? Right? All right. Correct. Not A, not B, C. Clear? Market cap, also called as value. Clear? In reality, all you need to focus is value, growth, and a combination of both, which is called blend. Blend. Value, growth, and blend. Got it? Now, compared to equity, the problem with fixed income indexes are least likely constructed on the basis of fixed incomes have maturity compared to equity, right? So either they're separated on the basis of maturity or the types of issuer, government index, corporate index, emerging market index, and so on, right? But these indexes are never created or differentiated based on the frequency of coupon. That's the least likely. They're asking which one is least likely. Maturity, yes. Different types of issuer, yes. Least likely options. Okay, I have a question. Least likely options are getting difficult. I'll repeat. See, I'll give you a secret hint about least likely. Okay, try this if it works. Whenever you see least likely, you need to do two things. Take a 3-second pause. One, two, three. Second, you need to think I'm looking for a wrong answer. So, fixed income indexes are constructed on the basis of coupons? No. They are constructed based on the credit rating. They're constructed based on different maturities, different types of issuer, but not coupon frequency. Coupon frequency globally is generally common. In US, it's semi-annual, most of the bonds. Rest of the world, it is annual. So that cannot be a differentiator between the different indexes. Indexes have these features. Why C depends on frequency, right? No, index doesn't depend on frequency. I think you're making a mistake here. Bonds depend on several factors. The question is asking, it's not a fixed income question. It's asking the indexes are created on what type of different features. So the differentiator between one index and other index cannot be because of coupon frequency. Got it? They are not asking that what are the different bonds are based on what. Bonds are based on several factors. They are asking fixed income indexes globally are based on what. Got it? Also in the notes, it's given what are the different types of fixed income indexes. Clear? So why not see if you have an question C, why not A? Why can't fixed income be on different maturity? Long-term bonds index is different. Short-term money market bonds index is different. Government bond indexes are different. Understood? Those are very common, in fact. Which of the following statement is most accurate? Commodity index all share same weighing methods. Do you think so? They all have the same methods, similar weighing methods? We don't know. Commodity index contains the same underlying commodities, offer similar returns. Guys, very interesting. See, commodities weighing method is same or not if you are not aware, correct? Commodities index, they have the same, first of all, even if I have the same commodity and you have the same commodity in your index, is it that we both will have the same returns? No, there is a high chance that I might buy at different rates, you might buy at different rates, right? So this is definitely wrong. B is definitely wrong. Third, performance of a commodity index can be quite different from that of the underlying commodities, isn't it? Now, remember here, you're looking for something which is most accurate. Okay. So, commodity index all share the same weighing methods. The index containing the same underlying commodities offer similar returns. The performance of commodity index can be quite different from that of the underlying commodities. Is it possible that the commodity index, gold index return is different, gold ETF return is different from the underlying gold? Is it possible? No. See, in commodities, it is very difficult because Most of the commodity funds, the underlying is a commodity which will perfectly reflect that, in fact. So suppose if I want to invest in a gold ETF, the reason I invest is that because my returns will replicate the underlying gold. So they are, ironically, they are very similar, correct? So are they different? No, they should not be different. People invest in commodity funds to get an exposure to commodity. So C is not the case. Understood? C is not the right answer. We are looking for one which is right. Commodity index containing the same underlying commodity offer similar returns means two commodity indexes will not, in fact, two funds, any two funds will never give me the same returns. So even this is an extreme statement. So here, what is the correct statement, which initially looked as, oh, this can be the least correct statement, right? So actually it is A. Everyone, commodity indexes, most of them have similar weighing methods. First of all, weighing methods. See, similar weighing methods. Why? Because there is no, commodities are not like stocks or bonds that they have a market cap. So most of the commodities are either weighed based on the consumption or the GDP, or what is the contribution of that commodity in the GDP, right? So most of them are based on common parameters. Got it? Understood, everyone? Correct? Clear, 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 clear. Okay. Yes. The returns of hedge fund indexes are most likely biased upwards, downwards, or similar. Very easy. They are most likely, the returns of hedge fund indexes are most likely, yes, biased upwards, biased downwards, similar across. See, because they are biased, it is always biased upward when they show downwards, isn't it? So that's biased upwards, upwards. Everything with me? Clear, clear, clear. Understood? Okay. Just a small correction. I am so sorry. I think we made a mistake here. Uh, which of the following statement? In the previous question, I think even I have some confusion there. Which of the following statement is most accurate? Most accurate. I think because it was presented differently. A, B, C, commodity index all share same weighing, commodity index containing the same the price, the performance of the commodity index can be quite different. There is some confusion. I think in my notes also I marked it star. I don't know why. We are looking for most accurate. Was it most accurate? Yes, commodity indexes all share the same weighing. They all have the same underlying, containing the same underlying commodities offer similar returns. The performance, we are looking for something which is correct, right? Most accurate. Bias. Just a moment. What is the issue here? Commodities indexes. In our notes, we mentioned commodity indexes. All of them have the weighing is based on the consumption, correct? So the performance is based on the how the fund is managed. Commodity index all share similar weighting. Okay. So guys, just I will confirm it, but I think most of the case because in my notes the marking is A, but I don't agree with it. I think it is C, comparing the choices if it is most accurate. So please just write right now C, the performance of commodity index can be quite different from that of the underlying commodities. Just mark this, everyone, just mark this point. Okay. I will still confirm it, but I think it is C. The answer there, it was mentioned as A in the notes where I had, but I don't agree to that. I think it is C. Okay, so just mark C. Okay. Still, if there is any changes, I'll let you know. Otherwise, it's C. Okay. The returns of the hedge fund indexes are most likely, yes, bias upwards. Everyone, correct? Yes. See, yes, as I said, to answer the previous question, just to address a doubt, performance of commodity index funds should be similar to commodity index. Yes. But the performance of commodity index and the underlying commodities, yes, yes. I think C is the answer. Why? Because see, underlying commodities Most of the funds, commodities funds, they don't invest in the underlying commodities. They invest in commodity derivatives. Understood? And therefore, their returns might not be the same. You take exposure in commodities using derivatives. All right. So therefore, yes, C is the answer, not it. Correct. Understood? So therefore, the returns will be very much different. Right? Next, the market value of an undervalued asset. What is an undervalued asset? An asset whose intrinsic value is higher than the market price. Correct? Everyone? So the market value of an underlying asset is greater than its intrinsic value or less than its intrinsic value. The market value of underlying undervalued asset is everyone less than its intrinsic value. Am I correct? See, what is undervalued? An investment is undervalued when its intrinsic value is higher than market price, isn't it? When its intrinsic value is higher than market price. So the market value of an underlying undervalued asset is greater than asset's intrinsic value? No. Is the value at which the asset can currently be bought or sold? Yes, no, everyone? Correct? The market value is what? The price at which the asset can be bought and sold. Am I correct? Yes or no? Everyone? Check, check, check. Please confirm me ABC, ABC. Everyone? Market value is not greater. It should be lower. If the market value is greater, it is overvalued. Equal to the present value? No, this is intrinsic value. Now, with respect to efficient market theory, when a market allows short selling, the efficiency is going to short selling is good for the market, right? So if there is short selling, there will be buyers and sellers, both are unlimited, right? So whenever short selling is allowed, it will eventually do what? Short selling will increase the efficiency. Am I correct? Right? Right? Okay. This is basically where we are basically looking from your efficient market hypothesis. Okay. With respect to efficient market hypothesis, if the security prices reflect only the past prices, guys, if you look here, something which takes into consideration only the past market data, that is called weak form, isn't it? Weak form efficient takes into account only the past. Correct? Correct. What is that? Something that takes into account past, present, and private information. So when prices reflect all public and private, all public means past and present, and private, this is called strong form efficient. Everyone with me? Strong form efficient. Remember, strong form efficient is only theoretical. Why is that so? Because in reality, private or insider information is not only unethical but illegal. Isn't it? Clear? Okay. Next, which of the following is least likely to explain the January effect anomaly? January effect anomaly is called calendar anomaly. What is a calendar anomaly? A calendar anomaly like January effect is when people get more returns in the month of January. And why is that so? Because in December, most of the people sell off their portfolio to create in DTA, we understood tax loss. Correct? So by booking loss on those where you have made loss, by booking that loss, you can reduce your tax bills. So basically, that's called tax loss selling. That is one of the reason. They are asking which one is not the reason. Which one is least likely to explain January? So A is definitely the case. Release of new information in January or window dressing of portfolio. What is window dressing of portfolio? Generally, at the end of the year, you have to disclose what your portfolio is. So the fund managers are reluctant to disclose. So they do what? Their secret shares, they sell it. So that's not discussed in the portfolio on the balance sheet. And then they rebuy that in January. That is called window dressing. Artificially showing something else, right? Because you don't want others to know what type of securities you hold. So these two are definitely the reason of January anomaly. Because of this, the price are low in December and high in January. But B is not the reason. Understood, everyone? Clear? Next. Okay, now we go to the overview of equity security. Overview. This is one of the easiest topics. The type of equity voting right that grants one vote for each share, which is a normal case. One vote each share is called statutory voting. What is combined voting, where you can add all your votes and give it to a single director? What is that called as? That is called cumulative voting, which is good from corporate governance point of view. Cumulative is better because that gives more representation to the minority shareholders. Okay. Now, when investing in unsponsored depository receipts, guys, there are two types of DRs, sponsored and unsponsored. Everyone. In the unsponsored, the issuer will do what? The issuer will itself go and issue the DRs. In the sponsored one, the issuer will do what? The issuer, what is the difference in the sponsored and unsponsored? See, check here. In the sponsored, when the foreign company has direct involvement in the issue, everyone. So when I have a direct involvement in the issue in the sponsored DR, the voting right is with the investor itself. But in an unsponsored, I don't get involved. I involve a bank. I issue the DRs through a bank. So who has the voting right? The voting rights are with the depository bank. This happens in an unsponsored DR. So in an unsponsored DR, the voting rights or the of the shares are with the depository bank. See, there is a confusion in the name. Unsponsored means I'm not sponsoring. I am having a bank to do so. Sponsored means I will itself issue. Got it? Try to remember it that way. Clear? From an investor's point of view, which of the following equity is the least risky? Least risky. Callable or puttable? Of course, puttable is the least risky. No. Lesser riskier than even non-callable, right? So puttable preferred shares are the least riskier because that gives me right to sell. All right. Okay. Now in this topic, they have asked you at the end book value and ROE also in the notes, which is very easy because by now you are already aware what is book value and ROE. Book value is nothing but it has different names: total assets minus total liability, NAV, shareholder fund, total equity, and so on. All you need to look out for is where is total assets and total liability. And trust me, these are some of your CFA Institute questions. So if you doubt what a stupid question it is, don't worry, there are such questions. So 12 minus 7.5, that is going to be, everyone, 4.5 million. Check, easy. Total asset minus total liability. Okay, let's find ROE. Can someone tell me what is the formula of ROE? We've done all of this in FSA. ROE is net income over total equity. But remember, in reality, the formula is average total equity. So if they give you both years value, you should take average. Correct? But if they don't give you both years value, then you are forced to use whichever total equity they give you. Beginning, mostly they will give you beginning. So I have total sales, income, and beginning of the year total assets and total liability. This will give me total equity. I just have beginning. So this is going to be 15 million. My net income is 2 million. So 2 divided by 15, that's going to be 13.33. That's going to be my ROE. Understood? If they give you average, beginning and ending, always go for beginning and ending. If not, then you can go for beginning. Got it? Understood? Okay. Now, there is something which many students, ironically, don't see there in their notes, which is degree of operating and financial leverage. Okay. Now, I know many students actually struggle with this. See, degree of operating leverage or degree of financial leverage, degree of change in its operating income, company's degree of. Okay. So, first of all, degree of operating leverage is due to fixed operating cost. So, degree of operating leverage, I'm just writing it here for your reference. Degree of operating leverage is due to fixed operating cost. Let me write it here. Degree of operating leverage is due to fixed operating cost, and degree of financial leverage is due to fixed financing cost. So the formula, actually the difference between where is this operating fixed cost? It is contribution over EBIT. The difference between both is your fixed cost. And the difference between EBIT and earnings before tax is due to fixed financing cost, that is interest. Okay. Now, just to give you an idea, we do a different types of income statement: sales minus cost of goods sold, right? Generally, we get gross profit. From that, we do operating expense and all, right? Now, instead of that, what if we subtract all the expenses as sales minus variable cost? What is this called as? Contribution. Minus, if we subtract the fixed cost, then we get the EBIT. From this, if I subtract the interest, then I get my earnings before tax. So guys, here, if you look at, this is my contribution, this is my fixed operating cost, and this is my fixed financing cost. So if you take these two things into consideration, you get degree of operating leverage. If you take these two into consideration, you get degree of financial leverage. So degree of operating leverage, degree of financial leverage is due to contribution over EBIT, and this is due to EBIT over EBT. Understood? This is your static formula. If they ask you dynamic in percentage, then how do you write it? It's somewhat similar, but I'm just doing it. It's, although it's there in the notes, it's percentage change, percentage change in EBIT due to contribution or sales. And this is percentage change in EBT or net income, if assuming there is no tax, due to operating margin or operating profit. This is also there in my notes. So most of the students skip this because it's not given too much of importance. So here, in this case, they have asked me what is degree of financial leverage, and they've given me increases from this to this. So operating income means EBIT, and net income, or you can say EBT or EPS. So what is my degree of financial leverage? It is percentage change in earnings over percentage change in operating profit. The difference between both is due to interest, isn't it? That's what degree of financial leverage is. So what is my change in earnings, guys? Earnings, you need to find this 1.8 divided by 1.5. This is 20 percentage, and operating, it is simply 10 percentage, correct? So 20 percentage divide by 10 percentage, your answer has to be 2. Are you with me, everyone? Clear? All right. Many students have not done this because sometimes, it's presented in a very small form. Okay. Hidden somewhere in the notes. That's why. The percentage change in the company's net income that results for a given percentage change in the operating income. We just did that. What is that called as? Degree of financial leverage. Operating leverage is due to fixed operating cost. When you add both operating and financial leverage, that is called total leverage. Understood? So whenever I say degree of operating leverage and degree of financial leverage together gives me degree of total leverage. I don't want you to memorize this formula. It's not needed, but you should know when you combine both, it's called the total leverage. Next is very easy. Company's EBITDA. What is EBITDA, guys? Earnings before interest, tax, depreciation, and amortization. So I don't need to deduct interest, tax, or depreciation. So sales minus cost minus operating expense. Should I deduct depreciation and amortization? No. So simply 1.5 million plus 0.9 million. Oh, sorry, 1.5 million is my revenue minus 0.9 million is my cost of sales minus 0.5 million. My EBITDA will be close to 350,000. Am I correct? Got it, everyone? EBITDA 350,000. Anyone has any doubt here? Anyone? Okay, very easy. Now, a very interesting thing. There is a question from economics. Do you remember in economics, there is something called Herfindahl-Horstman index? There is something called N-form concentration ratio and Herfindahl-Horstman index. Now, this HHI index is asked twice, either in economics or in equity. N-form is simply adding the market share, but HHI is doing the square. So if I want to do the square, so 0.5 square, now they've given me 0.5 square plus, I will do what? 0.3 square plus 0.2 square. Let us find out this. 0.5 square, store 1, 0.3 square, store 2, 0.2 square, store 3. Add all, you will get 0.38. So the answer should be 0.38 or 3800. What should be the case? Should it be 0.38 or 3800? Everyone. Now, guys, in reality, is there anything wrong if it is 0.38? What's the difference, 0.38 or 3800? So what is Herfindahl-Hirschman index? It is calculated as the sum of the squares, correct? Now here, if I calculate my HHI index, I can do the sum of the squares also. So if I do 50 percentage square, 30 percentage square, 20 percentage square, let's do that also. 50 percentage square, you will get 0.38. But 50 square, if I do 50 square, I get 2500. 30 square, I get 900. 20 square, I get 400. And if I add all, I get 3800 also. So, guys, what is wrong? I can either do this or this. How does it matter? Does it matter if I do 50 square plus 30 square plus 20 square? Then it gives me 3800. Now, if you see here, both are same, isn't it? But pick up one. It's either A or C. Which one is the correct way of calculation? B is definitely wrong. We all agree. Is it A or is it C? Just look out the word here. It's an index. It's a way to calculate an index. Understood? So A, even if it is mathematically correct, that's not an index. The correct way of calculation is when you take the full number. So the correct way of calculation is C. I'll repeat, A is not wrong, but the correct way of presenting the index is C. And that's the reason why you joined doing these questions with me. Because sometimes you need to know these micro differences. Again, you can argue what is wrong with A? Nothing wrong, but that's not the way we present. We present it in the whole numbers like this. Answer is same. This is very important. Okay, many students end up arguing with me. No, there is nothing wrong. I'm just presenting you what the CFA Institute does. These are not my homemade questions. Got it? Understood? Clear? Right. Nothing wrong with A, but C is correct. Remember, I told you this strategy in ethics also. Something which is right, something other thing which is right, which one is more correct, you need to present. That's an index. Okay? So the appropriate way of calculating is this. Clear? Understood? Okay. Now, next, PESSEL analysis. What is PESSEL? PESSEL. What is the full form of PESSEL? Can anyone remind me what is PESSEL? What are the PESSEL factors that affect the stock? See, PESSEL factors, these are different factors that you need to take into consideration. We are basically under which section? We are under this particular, there are these three readings which are very theoretical in nature of that industry and competitive analysis. What is PESSEL analysis? These are external factors that affect the stock. The P stands for political, economical, social, T stands for technological, I stands for PESTL, PESTL. L stands for legal, and last E stands for environmental or ESG. These are outside factors which will affect your industries. Correct? We learn Michael Porter's five forces, and these are PESTL factors. So, which of the factors affect the industry from outside? PESTL analysis is a framework for identifying industry themes, the level of industry concentration. No, industry concentration we just saw is using HHI index, correct? Determinants of industry profitability. What are the determinants of industry profitability? Is that PESTL analysis? No, determinants of industry profitability is whether the industry will be profitable or not. That is by Michael Porter's five forces. That is Porter's five forces. Porter's five forces. They define whether the industry will be profitable or not. So PESTL is a framework for identifying what? Industry themes. What do I mean by industry themes? It tells us that what industry is affected by these external factors. So PESTL is a framework for identifying themes or narratives. Understood? So PESTL is an external factor affecting the industry, but determinants of profitability are Porter's five forces. Industry concentration is index, HHI index. Clear? Slightly tricky. Which one of the following is most likely a risk of executing a differentiation competitive strategy? When you're going to be a differentiator, see, either you can be the lowest cost producer, or you can be a differentiator. Differentiator in terms of premium. You will be probably giving premium service like Apple. Which of the following is most likely a risk? Pricing premiums become too high. See, Apple phones, when they become too high, right now people are buying it because it's like a webland goods. But in the long run, if there's gonna be no upgrade, people will not keep on forever buying Apple iPhones or upgrading. So what is the biggest risk? Pricing premiums become too high. Yes. Larger competitors outcompete on price. Desire for premiumization amongst customer. What is the risk here? The risk. Everyone. Which one do you think is the risk here? The risk is that the premiums become so high that people don't buy itself. Understood? That is the biggest risk when your focus is on premium market. Sometimes the premium becomes so high that even those who want, they won't buy it. Unless and until it's a luxury good and people are buying just for, the brand. Got it? Forecast objects should be. Now, these are very micro theoretical aspects. Forecast objects should be based on independent third party. Should I base it on third party reports? Based on individual discrete items, not aggregation, or disclosed regularly, or based on items that are disclosed regularly. See, whenever we are going to do the forecasting, we are going to prepare a pro forma income statement, financial statement to forecast the future earnings of the company or valuation of the company, right? In such a case, my forecasting process, I need to disclose it, right? Yes or no? I need to disclose it rather than depending on the third party. So disclose regularly, or it should be based on items which are disclosed regularly. This is something that most of you all might not have read if you all have not read the theoretical part. So these are also some theoretical questions that you should expect. You should not only expect the plain calculation questions. Got it? Many of these are based on your intuition and general knowledge also. Next, see, this should be relatively easy based on your knowledge. Management guidance is most appropriately used by analysts in forecasting what? Capex of the company, pricing of commodities sold by the company, revenue of a company sensitive to the business cycle. Which one will give you an idea about about the company from the management? Yes, it is capex. Capex related information, because capex decisions are taken by the management. Okay. They do not have the information on the prices of commodities sold by the company. Now, that is something that even honestly, they can't even reveal what prices will keep and all. That is not even acceptable, because, and also that is dependent on various factors, market factors. So they can't give me that information with assurance. But capex is definitely a decision by the management. Understood? Understood? Which of the following is an example of a top-down driver of revenue for a passenger airline? Uh, See, every time you ask me a question, why not C? Why not C? Also tell me why not A. I'll explain you why not C. But why not A? Isn't CapEx information given by management? They can give me that information, right? Correct? First. Second, now I'll come to C, revenue of a company. Revenue of a company is sensitive to the business cycle. Guys, if the revenue of the company is dependent on the business cycle, how can management give me a guidance on that? Do the managements have any control on the business cycle? No. Understood? So managements do not have a control or prediction on the business cycle. In fact, the theory says that the investors have more predictable power than the management when it comes to analyzing the economy. So management can only give you guidance on what they control. They can't give you on guidance relatively on something that is outside the control. See, in a normal business, I can give you what will be my tentative revenue in which direction. But if my business is very cyclical, it's difficult. They do not have information advantage in this case. I don't have an advantage when the business is cyclical. So whether the business is cyclical or not, capex decisions are mine. Got it? So between A and C, definitely something which is in the management control, they can give you guidance on that. Pricing of a commodity business which is volatile or revenue business cyclical, that management is difficult to guide. Got it? Anything which is control of management, they can guide. Debt equity ratio, that is in control of management, that they can give you guidance on. Capital structure, capex, all this discussion management can like give you their guidance. Next, which of the following is an example of a top-down driver of revenue of a passenger airline like Indigo? Market share of routes, number of planes in fleet, or average ticket price per mile flown? See, number of planes in the fleet and average ticket price, these are company specific parameters. Understood? These are company specific things. Okay. What is a top-down driver? Top-down driver is something which I will get from the industry who has which share. Number of planes and average ticket price is a company specific. That is a part of your bottom-up source. So this is actually related to bottom-up. Why? Because this information I'll get from the company. Market share of the routes. This is top-down information. This is where I get overall what is the traffic, who has how much share, and out of that, how much is the share of my airline. So that's a top-down driver of revenue to estimate. That is, you estimate how much is the market share and then you try to forecast the revenue. That is one way. Bottom up is where you take the information of the company's financials and try to forecast the revenue. Understood? So B and C are bottom up. Got it? Okay. Now, finally, we move on to the last topic where there is a highest concentration of calculation. Okay, let's do that. Analyst estimates intrinsic value of the stock to be in the range of this 17 to 21. The current market price is 24. Very easy. Come on. Stock is overvalued, isn't it? It's outside the range of higher also, right? Analyst determines that the intrinsic value of equity is equal to 55. The current price is 47. It is undervalued. Don't be surprised if you get such questions in exam. You know what happens when such type of questions come in exam? I have students who start thinking, how can CFA exam be so easy? No, no, it is not something easy. There is something tricky. I paid so many thousands of dollars. I did so many coaching classes. It cannot be so easy. No, no, there is something tricky. They think like this. But they forget one thing, that the real exam, I'll repeat it for the 2000th time, the real exam is much more easier. But the preparation has to be the toughest. Understood? See, I give an analogy to many of my friends. Some of my friends are from the army here. So I tell them that you prepare day in and out with guns or with, with every necessity that is required in the army, every physical activity. But that doesn't mean you're going to shoot every day. You might get the enemy just once. Understood. But that doesn't mean that, oh, I should not be prepared. Your preparation is intense, even if the exam is just once or just for a fraction of a second. That's how it is. The CFA preparation has to be very high. Okay. Then it should not matter whether the exam is easy, difficult. The difficult and easy stuff is in your head. It's based on your preparation, how your preparation is. Got it? Asset-based valuation model. See, there are discounting cash flow model, P multiple models, and asset-based. Asset-based are generally used when the company is going to be liquidated or it is not a going concern. Okay. The intrinsic value of the common stock is based on estimated market value of the company's assets. No, it's based on company's net assets, not assets. What is net asset? Net asset is asset minus liability. It's based on company's net assets. Net asset is total equity, assets minus liabilities. Okay. So it's a technical thing. Which of the following is most likely used in a present value model? Present means discounting cash flow. Where do we use discounting cash flow? Price to free cash flow? No, it's a multiple. Enterprise value or free cash flow to equity? Everyone, which one? Which one? Where do I use the discounting? I use the discounting technique in which case? Either dividend or free cash flow. This is the place where I use the discounting cash flow technique. No one has given me the answer C. Everyone. So discounting cash flow, present value technique is used either for dividends or for FCFE. Only two ways to find the present value. Clear? Book value is least likely to be considered when multiplier model. No, in multiplier, we use price to book value ratio, right? Asset based, we are calculating NAV, which is nothing but book value, total assets minus total liabilities, or based on market value. If market value is not available, you use book value. Where we don't use is present value, because in present value, we use either dividend based model or FCFE. None of this you need book value. Clear? Understood? Next. Analyst is attempting to calculate the intrinsic value of the company and has gathered the following data: EBITDA, total market value of cash, short-term investment, liabilities, and preferred. The analyst is least likely. Guys, all of this information is required for what? It is actually required for enterprise value. Enterprise value for which you require all of this information, and EBITDA. So EV EBITDA ratio. So enterprise value or the value of the entire company. For that, you use this. So they're asking for which one you don't require this information. Is it multiplier model, discounted cash flow, or asset based? Everyone, ABC, ABC, let me know your answers. Check, 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 check. Guys, asset based valuation model is based on the company's valuation. So for this, I require the company's value information, all the company's value, total asset, total liability. I require all of the information. Multiplier model, when it is EV beta, that time also I require this. EV beta is also a multiplier model, not PE ratio alone. Again, the answer is discounting cash flow. I'll repeat, because in discounting cash flow, you require either dividend or FCFE. For FCFE, free cash flow to equity, you require CFO, fixed capital investment, and you require interest on minus T. You don't require all of these. Understood, everyone? Check, check, check. Clear? Okay. In FCFE model, the intrinsic value of the share of the stock is calculated as a present value of future expected FCFE. Isn't it? I don't even have to look at the other two choices. Let's still see present value of FCFE plus net borrowing. No. Minus. No. Only FCFE. Isn't it? FCFE includes all. Correct? Just to inform you, what is FCFE formula? CFO minus fixed capital plus interest on minus T. Okay. Okay, a Canadian life insurance company has issued 4.8% $25 par value perpetual non-convertible non-callable preferred stock. The required return is 4.49 on similar. They're asking for value. Guys, value for preferred security is preferred dividend. Simply the preferred dividend and divided by the cost of preferred share or opportunity cost or whatever you call cost of the preferred equity. Preferred dividend is 4.8% of 25. So 25 is your par value into 4.8%. That gives me 1.2. That gives me 1.2. Divide by 4.49%. That should be my value. Divide by 4.49%. I get a value of 26.73, 7261. Closest is B. Everyone is getting this? 26.73. Closest is B. Clear, clear, clear. Next. Please answer, okay? Two analysts estimating the value of a non-callable, non-convertible perpetual preferred stock with a constant dividend arrive at different estimated values. The most likely reason for the difference is, see, I know for preferred stock, the only reason that both of them may have different answer is either the preferred dividend is different or the cost is different, isn't it? Required return is different. So what is the difference due to? Different time horizon, different required rate of return, or different growth rate? Very easy. Let me know your answers, everyone. Check, 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 check. ABC, ABC, come on. Try. It's B. Why not C? Because guys, preferred stocks, in this case, there is no growth rate. Preferred stock, the dividend is constant. That's why not C. Understood, everyone? Clear? The Gordon growth model can be used to value the dividend paying companies. Gordon growth or the constant growth model, where the growth is assumed to be constant. Is it for which company? Expected to grow very fast, mature phase, or very sensitive to business cycle? Everyone, come on, tell me. Which company will grow at a constant rate? It is the mature business that will grow at a constant rate. Otherwise, you use two stage and three stage. Got it? Everyone? Next. Very interesting. Based on the dividend discount model, the stock is most likely. Now, this is a multi-stage information. You can do with timeline or you can do manually also. Now, your current stock price, current dividend per share, I've been given D0. Annual dividend from 1 to 4 and then fifth year onwards. So guys, what I do is I generally draw a timeline. So from 0 to 4, the growth is 9%. And after 4 years, they said that the growth is 4%. So basically, I'll require 4 dividends and P4. 4 dividends, D1, D2, D3. And in the fourth one, I'll require D4 and P4. Let's find that and store it in your calculator with me if you want to do this. So my D0 is 1.6. Growth 9% into 1.09. Are you getting your D1 as 1.744? Store 1 into again 1.09. Store 2, 1.9010. Into 1.09. Store 3, 2.072. Into 1.09. 2.2585. This is going to be my D4. Guys, I have stored all of them. Now, in order to find P4, I require D5, which is D4 into, what is the growth rate? 1.04 over the cost of equity minus the growth, the long-term growth rate. What is 12 minus 4? 8%. So whatever is your D4 into 1.04 equal to divide by 8%. Are you getting 29.3609? If yes, store 5. Store 5. Now go to the cash flow function. Those who have not seen my videos, they might not be aware of the function and everything that I'm using. So follow with me. Cash flow function. Go to cash flow function, clear the previous numbers. What will I put in C01? Ignore the CF0. You need to start putting from C01. So in C01, recall 1, enter. C02, recall 2, enter. C03, recall 3, enter. But in C04, you will add both of these things. So in C04, I do recall 4 plus recall 5 equal to, and then I press enter. That is 31.619. Once you press all of this, then you need to press NPV. NPV will ask you the discounting rate, which is 12%. So just put 12 when you press NPV 12, enter, compute. You should get 24.6421. So your intrinsic value should be 24.6421. But the market price is 22.56. Undervalued or overvalued, guys? Undervalued or overvalued? In the market, it is available cheap. I should say it is undervalued. Everyone with me? Got it? Got it? Check, 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 check. Isn't it? Perfect. Next, analyst is attempting to value the dominant company. The company just paid a dividend of 0.58. This is D0. Dividends are expected to grow 20% over the next year and 15% year after that. From the third year, they are expected to grow at 5.6 indefinitely. So guys, again, if you see the timeline, very interesting. Okay, you should know where the terminal value is. So 0, 1, 2, and 3. See, check out. First year, it will grow at 20%. Then the growth will be 15%. And then forever, it will grow at 5.6%. So that's going to happen after year 2. So my terminal value will be P2. So I require D1, D2, and I require P2. Are you with me on this? Check, check, check. What's going to be my D1? I have D0, 0.58 into 20%. So 0.58 into 1.2. You should get 0.69. That should be your 0.696. So 0.696. That should be your D1. Store it. Into 15, 1.15. That is 0.8004 should be your store 2. Now, when you go to P2, you require D3. So all you will do is multiply the D2 with 1.056 and divide it by 8.3 minus 5.6. So let me first do 8.3 minus 5.6. That is divided by 2.7%. So I have the D2 0.8 into 1.056 divide by 2.7 percentage. I get 31.30. I go to the cash flow, second clear. C01 will be recall 1, enter. C02 will be two things, recall 2 plus recall 3 of 31 equal to, enter, press NPV. Your discounting rate is 8.3. You should get a present value. Can someone tell me if they've got the present value? Are you getting a present value of 28.0152? 28.01. 0152. That should be your intrinsic value. They have asked what is the intrinsic value. I will say 28. Everyone with me? Correct? Are you getting this? Check, check, check. Where the terminal value is after which year, that is critical. Hideki Corporation has just paid a dividend of, what is it? Dividend of 450. Okay. So that's my D0. Annual dividends are expected to grow at the rate of 4% per year over the next 4 years. At the end of 4 years, the shares are expected to sell for 9,000. Guys, if they are expected to grow at 4% and if they give you the final year value, there is another way to solve it. Are you ready to see that? Are you ready to try something new? Everyone, check, check, check. Are you ready? Yes. Okay. See this. The dividend they paid is 450 is the current dividend, right? Annual dividends are expected to grow at 4% per year for the next 4 years. Now, what you can do is that you can find out D1 and then put the growth rate. So actually, if the dividend was same, you can put the growth rate and find the future value. Now that is one way, but here easily you can directly go to the cash flow function and start solving. What you can do, directly go to the cash flow function, directly go to the cash flow function. Your D0 is 450, right? So go to C01 and just put there 450 into in C01, 450 into 1.04, enter. Are you getting this? 468. See, your first value is 468, correct? So you can also store it. Again, you can do it quickly. So 450 into 1.04 is your store 1, into 1.04 store 2, into 1.04 store 3. So recall 1, recall 2, recall 3. Okay. Into 1.04. Now, instead of storing this as 4, instead of storing this value, you must have got 526. Add 9,000 also. 9,000. So you should get 9526. That will save your time. Got it? Now go to the cash flow function and then put directly recall 1, enter, recall 2, enter. Not a big difference. Recall 3, enter, recall 4, enter. NPV, your discounting rate is 12, enter. Compute, you should get the NPV of 7220. So what I just reduce one step. Instead of going for recall 5, you just can combine recall 4 and 5 easily because here they've given you the value. Understood? Nothing else. No, nothing a big difference. Just small amount of saving time. Clear? 7220, 7220 is my answer. Okay. Next, price earning ratio is derived from the Gordon's growth. See, what is the Gordon's growth price earning ratio? What is it called, by the way? Do you remember what is it called? It's called justified PE ratio. What is justified PE ratio? It requires three components. It requires the payout ratio, which is dividend over earnings, and cost of equity minus growth. This ratio will increase if the payout increases or growth increases, but if the cost of equity goes down. So the only component where it is inversely related is the required rate of return. Are you with me, everyone? Got it? Next, analyst gathers the following information about similar companies in the banking sector: First Bank, Prime Bank, and Pioneer Trust. Which of the companies most likely to be undervalued? Undervalued means its ratio should be lower. So who has the lowest price to book value ratio? Prime and Pioneer both have the lowest price to book value ratio. And P ratio, who has the lowest P ratio amongst these two? Amongst these two, Pioneer has the lowest. Everyone sure I should go with Pioneer? Everyone agree? First, I looked at price to book value because in the banking sector, actually, we look at price to book value first. But here, two banks had the same price to book value. Then I look at the other multiples also. Clear? Next, the market value of equity for a company calculated as enterprise value. Now, guys, what is enterprise value? See, enterprise value is, okay, enterprise value is market value of equity plus market value of debt plus market value of preferred minus cash and equivalents. Now, from this, if you want to find market value of equity, everything you need to subtract from EV except cash and equivalent, which you need to add. So, for calculating market value of equity from the EV, what will I do? Minus debt? No. Plus the market value of debt? True. And preferred minus short-term investment. Guys, will I do this? No. I am not going to do plus. From the EV, what will I do, guys? From the EV, I will subtract market value of debt, market value of preferred, and cash and equivalent or short-term investments. When they go there, they will be added. Am I correct? When I take it everything on the other side, check, check, check. So which is the correct one? C is the correct answer. Understood? Next, analyst has determined the appropriate EV EBITDA for Rainbow as 10.2. The analyst has also collected the information where you have EBITDA. Guys, you have EBITDA and you have the EV EBITDA multiple. So guys, when you multiply the EV EBITDA with the company's EBITDA, you will get the EV of the company. You will get the enterprise value of the company. So when you do 10.2 into 22 million, 10.2 into 22 million, you will get 224.4 million. That's going to be my EV. What have they asked here? They've given me market value of debt and cash. They are asking me for value of equity. Remember, we just discussed to find the value of equity, you require the EV 224.4 minus you will do market value of debt, that is 56, plus cash, that is 1.5. So minus 56 plus 1.5, that will give you 169.9, which is roughly A. Are you getting this? A closest, right? Next, enterprise value is most often determined as market cap of common equity and preferred equity minus the cash equivalent. One more thing is missing, equity, preferred, and debt. So I will have to plus what? Plus what? Book value or market value of debt. And guys, not just debt or long-term debt. Very interesting. Which debt? Only long-term or long-term and short-term both? Guys, which debt? Very tricky. B and C both look similar, right? So when I say market value of debt, it is long-term and short-term both, not only long-term. So the answer is B, because when I say debt, when I say market value of debt, it is long-term plus short-term both. Got it? Got it? Got it? Asset-based valuation models are best suitable for which type of companies that does not have a high proportion of what type of assets? Intangible assets. Yes, it's not suitable for company which has high proportion of intangible assets, or or basically it is only suitable for company which are about to be liquidated or they have high tangible assets. Got it, everyone? All right. Very interesting. Equity. Perfect. Very scoring. Whatever variety I've practiced, most of these are CFA Institute's amazing questions. Some of them are very simple. Don't do simple ones. Do not doubt the simple ones. Okay. All right. Perfect. Thank you.